Your mortgage payment went up again this month. Maybe $50, maybe $100. You did the math, you checked the rate, and the number still felt wrong. What you didn't know is that the interest rate baked into that payment was shaped, at least in part, by a market you have never heard of, cannot see, and until very recently, no regulator could fully see either. On October 2, 2023, the SEC finalized rules reclassifying which financial contracts count as security-based swaps. The CFTC followed with its own amendments in December. Together, they forced a $600 trillion market into public reporting for the first time. That number is not a typo. $600 trillion, according to the Bank for International Settlements. That is the notional value of derivatives contracts outstanding globally as of mid-2023. That is 7 times the entire world's annual economic output. For decades, enormous portions of that market reported to nobody. No public database, no regulator with a complete picture. Just contracts between banks moving risk invisibly. The new rules changed that. Trillions in swap contracts that previously lived in the dark are now required to be filed with registered reporting repositories. The first compliance deadline, May 15, 2024, passed with dozens of major institutions still not fully registered. CFTC Chair Rostin Behnam said it plainly in October 2023. The derivatives markets are critical to price discovery and risk management across the economy, from farmers hedging crop prices to airlines managing fuel costs. Your gas price, your mortgage rate, your grocery bill, all of them touched by a market most people cannot name. The question now is not what the new rules say. The rules are public. The question is what was sitting in the dark before regulators looked. And what is still sitting there now? The last time this exact gap went unaddressed, it didn't cost one bank. It cost the global economy $22 trillion in erased wealth. Here is the simplest version of what a derivative actually is. 2 parties sign a contract. That contract has no value of its own. Its value comes entirely from something else. A price, a rate, a number that changes in the real world. That is it, that is the whole idea. Say a wheat farmer in Kansas needs to sell his harvest in 6 months. He does not know what wheat will cost by then. A food company on the other side of that trade needs to buy wheat in 6 months and has the same problem. They agree today on a price for a future delivery. The farmer locks in his revenue. The company locks in its cost. Neither one is gambling. Both of them are removing uncertainty from a business decision. That is the original logic, and it still works that way for thousands of companies every single day. Now scale it up, over 90% of Fortune 500 companies use derivatives, according to the International Swaps and Derivatives Association. Airlines use them to lock in jet fuel prices months in advance. A German automaker with factories in Mexico uses them to fix the exchange rate between euros and pesos. A regional bank uses them to manage what it pays depositors versus what it earns on loans. 4 categories dominate the market. Interest rate swaps, where 2 parties trade fixed payments for floating ones, make up the largest share by far. Currency swaps protect against exchange rate swings. Commodity derivatives cover everything from crude oil to soybeans. Credit default swaps act like insurance on corporate bonds. If a company defaults, the seller of the swap pays out. That brings us to the $600 trillion number. The Bank for International Settlements reported in December 2023 that the total notional value of outstanding derivatives contracts globally was $600 trillion. Notional means the underlying amount the contract references, not the money actually changing hands. The real exposure, after offsetting positions cancel each other out, is 2 to 3% of that figure. Still, 2% of $600 trillion is $12 trillion. That is not a rounding error. That is larger than the entire United States economy. The number exists because these contracts stack. A bank writes a swap with a pension fund. It hedges that position with another bank. That bank hedges with a third. Each contract references the same underlying rate, but each one adds to the notional total. The same dollar of risk gets counted multiple times across the chain. Which raises the question the SEC and CFTC finally had to answer in 2023. If this chain of contracts is this large, why did regulators allow most of it to trade with no central reporting requirement for over a decade after the last financial crisis? Here is what the actual paperwork says. On October 2, 2023, the SEC adopted final rules under Release No. 34-98614. Those rules did something specific. They defined which contracts now count as security-based swaps and required every dealer above a threshold to register with the agency and report trades to a registered swap data repository. A centralized database built to make these contracts visible for the first time. The threshold matters. The CFTC had already lowered its own dealer registration cutoff in September 2020. Dropping the notional trigger from $8 billion to $3 billion. That single number change pulled hundreds of smaller dealer institutions into the regulatory perimeter they had previously sat outside. The filing tells a different story than the press release. The International Swaps and Derivatives Association, the industry's own trade group, ran a compliance survey after the October rules landed. The results were uncomfortable. Significant gaps remained in swap data repository registration among smaller dealer institutions. Firms that were now legally required to report were not yet reporting. The Bank for International Settlements put the global notional outstanding at $667.2 trillion as of December 2023. That number is almost impossible to hold in your head. The critical word is notional. The face value of contracts, not actual money at risk. The real exposure is a fraction of that figure. Still, a fraction of $667 trillion is not a small number. The new rules also triggered real-time public dissemination requirements. Trades must now be reported within 15 minutes of execution. Before October 2023, many of these contracts were reported to nobody. Hester Peirce, an SEC commissioner who dissented on parts of the rulemaking, raised a pointed concern. Definitional changes at this scale create compliance costs that fall hardest on smaller institutions, not the largest dealers who already had reporting infrastructure built. If the BIS counted $667 trillion in notional outstanding, and regulators were only now capturing full reporting as of late 2023, what exactly was sitting in the dark before the deadline passed? Here is the thing about 2008 that most people still get wrong. The mortgages didn't break the system. The contracts written on top of the mortgages did. Contracts so large, so tangled, and so invisible to regulators that nobody knew who actually owed what until it was already too late. The Financial Crisis Inquiry Commission spent 2 years tracing the wreckage. Its 2011 final report identified one mechanism above all others as the primary transmission channel for systemic collapse: the opacity of the OTC derivatives market. Not greed, not fraud, opacity. Regulators could not see the exposure in real time. One division inside one insurance company had written $441 billion worth of credit default swap protection. That is $441 billion in promises to pay out if loan bundles failed. They held almost no capital against those promises. No single regulator had a complete picture of that exposure until the Federal Reserve was already writing the bailout. The total cost to the U.S. economy was estimated by the Dallas Federal Reserve at $22 trillion. Lost output, lost wealth, lost jobs. $22 trillion in real economic damage, traceable in part to contracts that existed outside any reporting requirement. Dodd-Frank passed in 2010. It was supposed to seal the gap, but the jurisdictional split between the SEC and CFTC left security-based swaps underregulated for 13 years. The 2023 rules are the correction. But here is the bleakest number in this entire story. The Bank for International Settlements reported that, as of December 2023, the gross market value of OTC derivatives stood at $3 trillion, not $600 trillion notional. The real tangible exposure, $3 trillion, that's the actual replacement cost if every counterparty defaulted simultaneously. That $3 trillion sits inside institutions that are still completing registration under rules that took effect months ago. Which raises the only question that matters now. If a stress event hit tomorrow, would the new reporting system actually catch it in time? Or would regulators be reading the same post-mortem report 10 years from now? Here is what all of this actually costs you. Your mortgage rate is not set by your bank. It is shaped by the interest rate swap market. A $400 trillion corner of that $600 trillion system. When banks offer you a fixed-rate mortgage, they use swaps to hedge their own risk. The price of that hedge gets passed to you, folded into the rate on your statement. The new reporting rules mean regulators can now see those hedge positions clearly. For the first time, whether that visibility eventually compresses costs remains unanswered. The number on the gas pump works the same way. Energy companies lock in future prices through commodity derivatives. Grain traders do it too. Those contracts priced months in advance become the floor price you pay at checkout and at the pump. The ISTA estimates over 90% of Fortune 500 companies run these hedges. You pay the result every week. Pension funds are the quieter exposure. Funds managing retirement savings for teachers, firefighters, and nurses hold derivatives as hedges against interest rate swings. If a counterparty fails to post adequate collateral, the fund absorbs the loss. That loss shows up as a smaller return on a printed statement sitting on someone's dining room table. Here is what you can actually do with this. The CFTC publishes its Commitments of Traders report every Friday. It is free. It shows you who holds large positions in commodity derivatives. Energy, agriculture, metals. You can read it at CFTC. Gov, it is not light reading, but the summary tables are plain enough. The Bank for International Settlements releases quarterly data on the full global derivatives market. Also free, it is the closest thing to a public window into the $600 trillion number. Your own bank or broker is required to disclose swap-related activity in your account statements. Look for a section labeled Derivatives Disclosure or Swap Confirmation. Most people never open it. That person at the kitchen table, mortgage bill in hand, was not wrong to feel like something was off. The rate, the price, the balance. All of it connects to a market that, until November 2023, reported almost nothing to anyone. Now it reports, the positions are visible. A regulator can see the full stack of contracts for the first time in the market's history. What they choose to do with that view is the question nobody has answered yet. The door is open. Whether anyone walks through it is the story still being written. Subscribe for new breakdown like this every day.